Good afternoon. My name is Nishant Allen, and I'm here with Lauren, Yenlin, Yareen, and Christina to present to you the RSI case. The purpose of this report is to discuss reviewing Spot Inc.'s strategic options and how it should proceed in order to meet its goals. The analysis will provide the management team with a clear understanding of RSI's current situation, analyze the strategic options available to the company, and provide a recommendation on how to proceed. The first thing we will assess is the overall mission and vision of both RSI and Lavish. The RSI mission details that it is to run a profitable business by providing affordable massage and other spa services in a warm and welcoming environment. It includes that the staff is professionally trained, they provide individualized treatments tailored to client needs, and are open to feedback to encourage repeat business and referrals. Lastly, the statement includes their respect of the environment. On the other hand, Lavish's statement expresses that their philosophy focuses on creating an atmosphere to rebuild strength, recapture energy. Overall, it embodies a more spiritual experience and boasts their innovation, passion of their employees, and exceptional personalized service. They also include their focus on teaching wellness and stress prevention in order to improve their clients' overall health. Overall, though, the differences between the two are Lavish's mission doesn't reference the environment. They both don't reference helping the community. RSI appears focused on affordable services and health benefits, and Lavish is more focused on escape and pampering. Now, the key success factors in any player in the industry require are convenient, clean locations, unique, modern services, a high-quality products, competitive pricing, and a solid reputation.
We have 4 strategic options to expand RSI's business. The first option is to consolidate RSI and Lavish to operate under one brand identity. This option is consistent with Sally's mandate, and the consolidation will create a cohesive strategy to strengthen the company and result in cost savings and centralized and faster decision-making. The consolidated financial statement will provide a stronger view of the company, making it easier to acquire funding. There will be some challenges when consolidating the two companies in terms of operations, employee bonus program, and accounting policies. Besides, the customer range might be less diverse when combined. Our quantitative analysis shows that the two companies are more profitable operating individually than combined, primarily due to the accounting treatment of the amortization of intangible assets. There will still be some room for cost savings if the operating expenses, such as administration and marketing, are combined. Overall, this option is aligned with RSI's vision to become a leading reputable spa brand. There will be minimal requirement for financing, and there's no significant tax implications. The second option is to expand through franchising. This is a very effective method to capture the market while utilizing the capital from potential franchisees. It can help RSI to expand into new geographical areas faster than doing so on its own. This option builds a reputable brand name, while experienced franchisees integrate their operations into RSI's. Some downsides include different values between RSI and potential franchisees, which may cause damages to the brand if not handled correctly. The CEO and other core shareholders have no experience in this type of business, and they cannot devote enough time to manage this expansion. Finding ideal locations for the franchises might be difficult, and screening process can be very time-consuming and costly. The upfront cost of the franchise is $250,000 plus $65,000 for the first year's activity. To break even at startup, RSI needs 8 franchises. 5 of them will be able to cover the ongoing costs. However, the profitability will be depending on the number of therapists at those locations. Overall, this option is also aligned with RSI's vision to become a reputable leading spa, and it helps to build a network. RSI should be able to finance it, and there is no significant tax implication.
Strategic option number 3 is the partnership with Forever Fit Limited. A partnership with FFL would provide RSI the opportunity for expansion by operating massage therapy centers in existing FFL fitness centers. The advantages are as follows. First of all, it allows RSI to expand its business without taking 100% of the risk. Another advantage is that it allows RSI to access an existing customer base that is health conscious. Another advantage is there's a possibility for integration between RSI's goals to improve employees' retention rate and MTC partnership. Now, on to the disadvantages. RSI is not getting brand promotion through MTC. Another disadvantage is MTC's operations will depend significantly on FFL's financial ability, stability, and each FFL's location visitors volume. Is the directors are in this mindset that this will be an easy growth strategy with minimal involvement and risk. However, it is recommended that due diligence must be performed to ensure that RSI is receiving all the information for FFL that is correct and can be supported. So now, on to the financial analysis. The profitability analysis shows that this project projected profits are approximately 3 times the initial investment in the first year, which is $50,000. At the beginning, if MTC generates a net loss and RSI is in a partnership, will allow RSI and FFL to use income splitting and reduce taxes payable from other parts of the perspective. However, as the business grows, it is recommended that they incorporate the business in order to limit liability as well. Strategic option number 4 is to acquire Pure Substance Inc. The purchase of Pure is an opportunity for RSI to grow profitability by acquiring a line of products already used. The advantages are that vertically integrating RSI supply chain has the potential to reduce cost and improve efficiencies between RSI and Pure. Gives control over value chain and cost while blocking access to competitors. Another advantage is that with the industry trending towards environmentally friendly products, RSI will now not only be able to say it sells products, but also that it manufactures them. The cons are that RSI has no experience in managing manufacturing operations or expertise in the production of organic products. Increased foreign competition will put downward pressure on prices, hurting Pure's already falling margins, and cost to produce significantly, especially freight costs relative to revenue, has been rising significantly. They do not have experience operating, and which is not within RSI's mission to provide. In reviewing Pure's financial statements, the following observations can be made. Revenue has been consistently decreasing over the last few years, while COGS has been increasing. Range depending on purchase price and amount of shareholder invest. Ability for future earnings to cover interest and borrowing require the purchase of the company to be $6 million times 6%, which is $360,000 per year.
Having looked at the pros and cons of the various strategic options being considered, we will now discuss the criteria that we have used for weighing these options. The first criteria is a strategic fit. Criteria 2 is improves brand recognition. The third criteria is meets growth objectives. Fourth criteria is meets constraints and targets. And the fifth criteria is resources. Based on our analysis, we recommend consolidation of RSI and Lavish from an operational and financial perspective, partnership with FFL, and franchising the RSI brand. We do not recommend the acquisition of Pure Substances Incorporated. To quickly look at the recommendations in depth, consolidation of RSI and Lavish. We are of the opinion that both RSI and Lavish should retain their brand names and spa styles. However, support functions such as accounting, information systems, administration, and banking should be combined. We also recommend implementing a standard employee bonus scheme for employees of both Lavish and RSI. Partnership with FFL. This is a highly profitable option with the ability to generate internal funds for future expansion. There's also a possibility to improve RSI's employee retention rate. We recommend that RSI insists that RSI brand logo be exhibited at all massage therapy centers of FFL. Franchising the RSI brand. Although a lucrative option, We recommend that this option be postponed or delayed by a year, considering that RSI management lacks experience and resources to undertake it. Acquisition of Pure Substances Incorporated. This is not a recommended option considering the deteriorating financial health of Pure Substances and also the fact that RSI management lacks experience in a products company. Moving on to the implementation plan, we feel that consolidation of RSI and Lavish as well as partnership with FFL are two options to be implemented immediately, whereas franchising the RSI brand be delayed by a year. Moving on to the financing options, considering the stringent covenant from the bank and also to ensure shareholder satisfaction, we recommend acquiring funds from Blair Cummings. To quickly look at the financial forecast, we're of the opinion that by implementing the recommended options, RSI will be able to achieve a higher income and higher profits in the year 2016.
RSI currently uses CCA to depreciate its capital assets, while ASPE requires a systematic and rational basis over an expected useful life. There's also a potential write-down of inventory. Lavish currently uses a loyalty program that doesn't set up a liability, and as well, there's also a potential inventory write-down and contingent liability issues. For liquidity, both companies have a strong cash debt coverage. Lavish is at 1.8 and RSI is at 1.1. Both are increases from 2014. Although their current ratios are below 1, the company does not have a liquidity problem as they both generate significant cash flows from operations. Inventory may be a potential concern given the decreasing turnover rates for both companies year to year. Solvency-wise, again, both companies have strong current cash debt coverage and generate significant cash flows from operations. However, borrowing may be a challenge as both companies have a debt-to-asset ratio of 70%. Overall, though, both companies seem profitable and financially healthy. To conclude the financial summary section, we'll discuss the quantitative constraints. RSI currently has a $15 million bank loan with the following covenants. The financial statements need to be prepared in accordance with ASPE. An audit will occur if a debt exceeds $10 million, or review is otherwise acceptable. The debt-to-equity maximum is 1:1. The maximum debt-to-asset ratio is 1:2. There are no payouts to shareholders if interest coverage ratio is below 10 times. And lastly, the bank may demand payment in full immediately in the event on default of payments.
We will now briefly discuss RSI's operational issues. First, we recommend that the vision and mission should be updated to as follows. The vision should be to become the reputable leading spa for Canadian spa goers by growing RSI's brand geographically. And the recommended mission is to provide exceptional client-centered spa and therapy services to enthuse clients in an atmosphere that is relaxing and in a manner that is environmentally friendly and sustainable. We also recommend some major performance management improvements to help deal with the issues addressed in this company. First, we recommend you implement a balanced scorecard, which will communicate with the employees what management is trying to accomplish and help align the business activities and operations with the goals of the shareholders. The proposed performance metrics include percentage of revenue from new sources, number of complaints, utilization rates, and attendance at workshops. We also recommend an updated corporate structure which will keep RSI and Lavish's spa operations separate but share an administration, IT, and accounting functions. This will include investing in a new IT and accounting system to share between the two companies. We also recommend consolidating the accounting and the financials of the two entities. As already noted, we've recommended ASPE for the consolidated entity, which will entice potential external funders and provide standards for internal comparability. To implement ASPE, RSI will have to retrospectively change their financial statements. As part of this consolidation, we also recommend the bank accounts between the two companies become consolidated. Finally, we recommend a standard employee bonus scheme that should be introduced amongst the two companies and will be split between the two employment levels. While the bonus structure will still be based on revenue, it will also integrate the balanced scorecard. Management should expect to see a wage and benefit expense increase of 30% for RSI and 15% for lavish. Finally, corporate governance should be improved by adapting ASPE and ensuring the board has appropriate financial background. We recommend offering Blair Cummings a seat on the board by converting his debt to equity, as he has the appropriate financial understanding to guide the company. This concludes our presentation. Please feel free to reach out to us if you have any questions. Thank you.